In the midst of the 2009 recession, Warren Buffett bought a railroad. People said he's crazy. Commentators asked him why he was buying a railroad. He said,
"If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability."
During a recession, most people panic and act out of emotion. People look for cheaper alternatives to meet their needs. With the investment, most people say, "I want out now. I'll be back when things get back to normal." But few people do things differently.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
During a recession, there is more supply for investment than demand for them. There are more people willing to sell their investment than there are those willing to buy them. The media plays a vital role in spreading fear and terror. Prices of stock, real estate and other investments drop. Now, the challenge is usually with knowing when an investment is considered cheap. For instance, if a stock price falls from $150 to $95 within 1 month, it could go further down to $65, $45, even $35, depending on how long the recession lasts. The challenge is usually with knowing at what point the price had hit the bottom. If you buy at $65, the price could go further down to $35, which means you'll have lost about 38% of your investment. It is the fear of buying when it could still go down that hold people from investing during a recession. A lot of people will panic and sell out of fear of losing more money. Smart investors, however, invest for the long term. They understand that what matters is that you buy at a cheap price and then hold. They may lose further down the line, but once things start recovering, they will be in a better position for profit. Most people don't have the patience to step back and watch their investment lose money. The patient investor is one of the types of people that end up winning through a recession. It takes courage, knowledge and leverage to pull this out.
Investors have to be able to detach themselves from those emotionally and temperamentally from that tendency to go along with crowd behavior.
Icahn is another legendary fund investor with a stellar track record of investing in distressed securities and assets during downturns. His expertise is in buying companies and gambling firms in particular. In the past, he has acquired 3 Las Vegas gaming properties during financial hardships and sold them at a hefty profit when industry conditions improved. To prove Icahn knows market peaks and troughs, he sold the 3 properties in 2007 for approximately $1.3 billion, many times his original investment. He began negotiations again during the credit crisis and was able to secure the bankrupt Fontainebleau property in Vegas for approximately $155 million, or about 4% of the estimated cost to build the property. Icahn ended up selling the unfinished property for nearly $600 million in 2017 to 2 investment firms, making nearly 4 times his original investment.
The real money that I made over the years is holding companies for 7, 8, 9 years and keeping them. I've looked back, we bought casinos, and you gotta buy them when nobody wants them, really. That's the real secret. You buy things, it sounds very simple, but it's very hard to do. When everybody hates it, you buy them. And then when everybody wants them, you sell it to them.
Though not a true individual investor, Jamie Dimon used fear to his advantage during the credit crisis, making huge gains for JP Morgan. At the height of the financial crisis, Dimon used the strength of his bank's balance sheet to acquire Bear Stearns and Washington Mutual, which were 2 financial institutions brought to ruins by huge bets on U.S. housing. JP Morgan acquired Bear Stearns for $10 a share, or roughly 15% of its value from early March 2008. In September of that year, it also acquired WAMU. The purchase price was also for a fraction of WAMU's value earlier in the year. From its lows in March 2009, shares of JP Morgan more than tripled over 10 years and have made shareholders and its CEO quite wealthy.
There was essentially crappier mortgages being put into these pools, and it didn't seem investors seemed to care, and it didn't seem the ratings agencies seemed to care.
Michael Burry is one of the most influential investors of our time. He became famous after he correctly predicted the housing crash of 2008 to 2009 and made a fortune by shorting it.
I called up the prospectuses and I read the prospectuses and I looked at these pools. I could see the credit standards within these pools deteriorating, just quarter to quarter.
In 2005, Burry's focus turned to the subprime market. Through his analysis of mortgage lending practices and bank balance sheets in 2003 and 2004, he began to notice significant irregularities in this market, correctly predicting that the housing bubble would collapse as early as 2007.
The housing market is propped up on these bad loans. It's a time bomb, and I want to short it.
He saw the riskiness of the subprime market as millions of borrowers with low income and no assets bought homes with enormous leverage, in many cases, making no down payments for mortgages that they couldn't afford when interest rates would eventually rise. Yet, the banking system was valued as if these mortgages were all solid. Burry realized this would be unsustainable long-term and that the credit products based on these subprime mortgages would plummet in value as soon as higher rates replaced the original rates. This conclusion led him to short the housing market by convincing Goldman Sachs and other investment banking companies to sell him credit default swaps against subprime deals he saw as vulnerable. In short, sell positions on the assumption that housing prices will drop. However, as prices continued surging, Burry's clients grew nervous and frustrated as he continued his short plays using derivatives. Unfortunately, or instead, fortunately in retrospect, when they demanded to withdraw their capital, Burry simply refused the investors' pleas by placing a moratorium on withdrawals from the fund, angering his clients even more. Eventually, Burry's analysis proved correct. In 2007, the market started to turn in his predicted direction as more insiders understood the system's risks. Then the dominoes began to drop, with Bear Stearns, Lehman Brothers, AIG, and the rest of the financial system behind them. Burry's bet paid off handsomely, earning him a hefty personal profit of $100 million and more than $700 million for his remaining investors. Ultimately, Icahn Capital documented returns of 489.34% between its November 1, 2000 founding and June 2008.
Made a ton of money, much more than I ever imagined, I'd ever have. We made $725 million, I think, on the funds in 2007.
The first thing to understand is that, unlike mutual funds, investing directly in shares comes with its share of risks and gains. To learn how to get started investing in stocks, watch the video in the end screen.